Peter Rose, Longwood Currency Trading. Cup of coffee. And the question is, how long does it take to increase your size? In other words, the more the size that you can trade, the more your net profits will be, and the closer you'll get to the point where you're going to be able to replace your job income. You have to determine what that level is as far as what your needs are. Are you trying to replace a $30,000 income, or are you trying to replace a $60,000 income? I mean, it's going to take a bigger bank to do that. If you take a very conservative, safe 20% a year on your money, you're making more money than you would anywhere else. So that's worth striving for. Is that all you can make, is 20% on your money? So if you had a $30,000 account, trading 3 fulls or 4 fulls or however you want to leverage that, 20% of that is $6,000 a year. Is that all you want to be able to make out of that $30,000? Well, no. I mean, I think that you could make significantly more than that. Could you make 40% or 80%? Yeah, you could. Whether that's going to be feasible as far as long-term development goes on just that size account, I don't know. You'd have to be pretty good in order to do that. Could you do it? Yeah, maybe. But the problem with looking at larger percentage gains is that you're going to have to take larger risks. You're going to have to dump more money in really early into the trade in order to maximize the amount of money you're going to make. Because if you don't, then the only other way to make that kind of money is to increase the number of pips that you win. And that's really where the problem comes in, is you have to build your skill so that you start learning on a certain pip value, whether that's I'm going to try to average 5 pips, or I'm going to try to average 10 pips or 8 pips, or whatever you're capable of doing, because you'll reach a capability level that you generally won't be able to exceed. For example, if you're looking to make 60 pips on a trade, you're just not going to be able to do that unless you're splattering that trade out over maybe 2 days or 3 days, or the lucky one where you'll do 200 pips in 15 minutes, okay? But we're just talking about reasonable expectation for the volatility of the underlying asset that you're looking to capitalize on, and your ability to, number one, pick the right time to get in there early enough, and number two, the guts that you've got as to holding on to that position while it runs its course, and being willing to take large drawdowns in the meantime to make a littler amount of money, just to make sure that you're not having a minor retracement. Those are all problems that you run into when you're doing long-term trading, when you're doing precision trading. I try to keep my trades to day trades. Yeah, they either work right away and I'm out, and I make my money in 15 minutes or an hour, or they're not working and I'm out in 5 minutes. You know, that's what I try to do. But as you trade bigger size, you take a little bit more risk on, because you're only adding small at the beginning and then starting to pack in as the thing moves in your favor, so that you do get a lot of stuff in. So it's a different manipulation of your entry analysis that you're going through. You're basically doing the same thing. It's just that when you do certain steps of that. So the question is, let's say your goal is to get to a $60,000 or $80,000 account or $100,000 account. How fast could you do that? And I'm not talking about taking a $20,000 account and building that up to $40,000. We're leaving that issue out of it. If you can do that, that's fine. But I think the issue that I'd rather address would be that you're trading a $10,000 account and you get good at that, and so you add another $20,000 into that from your savings or whatever, and now you're trading with a $30,000 account. Do you have to trade that differently than the $10,000 account? In my training that I do with folks, no, you don't. But if you're trying to replace your day job, you're not going to do that on a $30,000 account. So you might need a $50,000 or a $60,000 in order to make 30. Okay, and that's still a 60% return on your money. So you need to be pretty good in order to do that. You have to figure out what that represents from a pip basis. And that's part of your trading metrics that you develop as you go through. What's your average pip gain, what's your maximum pip gain that you make, the same way you would do what's your maximum loss that you've taken, and what's your average loss, how many losses in a row do you have, how many wins in a row do you have. All those kinds of metrics will help you determine the ultimate daily profit that you gain, and then you multiply that out by how many days a year you think you're going to be trading, and that'll determine what your yearly expected profit should be from your trading. There's a lot of math in doing that. You don't have to know how to do all that or do it. All you have to do is know when to bid ask, okay? That's really all you have to really know how to do. But the question has been proposed to me because I've done some videos recently where I've said, well, I was trading 6 lots, a $60,000 account several months ago, and now I'm trading sometimes as much as 25 lots at a time, or 20 lots. So, given the fact that you have that money to do, let's say you've got a couple $100,000. How long would it take you to go through that? I mean, look, you're not going to trade a $10,000 or a $20,000 account or even a $30,000 account and then go, oh, I got this, and then all of a sudden you want to start trading a $200,000 account so you can trade 20 fulls. Now, again, do you need $200,000 to trade 20 full lots? No, you don't. You probably need $150,000. It's just the way that I handle my risk management, and it's just another rule that I have. You can listen to this or not. I don't really care what you do. That's your risk that you're taking. You take your margin, and per lot, let's say it's $6,000 to go in. Right now it's $5,700 to trade some of the majors. From the daily requirement that the U.S. has of 5% of the cash value of the pair that you're trading at that particular time. So pound dollar, for example, right now is trading at, let me look at my chart here, 1.45, 1.53, somewhere in that range. So 150,000 times 5%, that's the amount of money you're going to have to come up with. That's about $5,500. So it'll take you a minimum of $5,500 just to cover your margin. So if you want to say come in with $6,000, you'd have $500 per lot, or 50 pips of runway. So if you in other words, if you let that go 50 pips, you would be down to the margin level and you couldn't trade a full lot again. But 50 pips is a lot. So I mean, if you take 3 10-pip losses in a row, you're 30 pips down from that, and you're going to start to get nervous. And so that's why I like to have, if I'm at 6,000 and I've got $10,000 per lot, then I've got $4,000 of runway. That's 400 pips, right? So I don't really have a lot of worry about running into margin requirements. You do whatever you want to do. In my videos that I've talked about, I've explained again that you cannot go from trading 3 full lots to trading 20 lots. Okay, there's a step that you have to go through. There's stepping from the 3 lot to maybe the 5 lot level. You might start to stage. You might start staging at the 3 lots. If you're really good and competent, you've got a great win-to-loss ratio, you realize that when you're staging, you're reducing the amount of profit that you could get if you would have gone all in. And going all in, if you have a lot of faith in yourself, going all in with 3 lots and coming all out with 3 full lots, you make 10 pips, you make $300, right, on that. So, and $300 a day, I mean, 10 pips, you could hopefully average that. $300 a day, 5 days a week, $1,500 a week. It's $72,000 a year on $300 a day. So that's on a $30,000 account. Are you going to be able to do that? Well, yeah, probably not, because you're not going to get 10 pips every day. And you're going to take some horrific losses too. So you don't want to start taking the $30,000 account and staging that, because you drop your average value and then you're still trying to get, you're hoping the price will go 10 pips or 20 pips, where you stage in halfway down, and now instead of 20 pips, you've got to make another 10 pips in order to make up for that stage difference. So you have to be careful with that. There's a time and a place to stage, and it's very difficult to get that right. And as I'll go through in my analysis of what I did, when you do get it wrong, it's a really big hit, and so therefore you've got to cut back on the size of your trading until you get back into the roll of things, because you don't want to take another hit. I took a $4,000 hit, so you don't want to take 2 or 3 of those, 4 of those in a row, because it's really hard to come back when you're down $12,000, $14,000, and you're trading big account. You don't want to take that next thing. So the first time you take that big hit, you want to cut back. There's other times when you start trading, or really when you have a lot of dry powder, you don't trade that whole thing. You don't think about staging that into the normal context. There's a way to do the staging. It's very sophisticated. I cover it exclusively in the 4th course book that I have, Advanced Trading Solutions. That it doesn't mean you can buy the 4th book. You buy them all or you buy nothing. But you just have to figure it out on your own. The question here to resolve in this video is, how long does it take to go from that 3 full lot to the point where you're trading significant lot size, so that each pip is worth a couple $100, which would be, on my thing, a $200,000 account. So you go from a $30,000 account to a $200,000 account. How long did that take me to do? Well, I started out this year, for the first 3 months, trading 3 full lots. So January, February, March, I was trading a $30,000 account. Sometimes I'd trade 10, sometimes I'd trade 40, but I was trading at that $30,000 level. In April, I went to a mix between $30,000 and a $60,000 account. So I was trading between 3 and 6 lots. In May, I went to 10 lots. In June, I went to 15, and by July, I was doing a couple of trades at 25 lots. So from let's call it April, basically 4 months, I went from trading 3 lots to trading 25. That's how fast you can learn how to do that. Once you learn how to use this stuff to your advantage, the leverage and the staging and the risk management, once you put those 3 pieces together, and it's all based on a good win-to-loss ratio, a good average win value, and a predictable average per trade value, you've got a solid confidence base that you can say, okay, I'm going to jump from 3 to 6. I'm going to go from 6 to 8, which I did in the middle of that month. I went from trading 3 lots to April. I was trading 3 to 6 and a couple of 8s, which gave me an average of 6. In May, I was trading 8 to 10 or 12 lots. In June, I was trading 8 to 20 lots, averaging 15. In July, I did a couple of trades at the 25 lot level. In August, I took a $4,000 hit. I immediately cut my lot size, and I was only trading 13 fulls. That was average, 13 lots, trading $130,000 bank. And the reason for that is because of that $4,000 loss, I learned something about how you make some of these transitions and how to better balance yourself. So now I'm into September. I think I'm 6% up. Let me take a look at my numbers here. I am in 3 trades. I made about $4,000, and I'm up 3% for the month, about 3% a month based on risk. And I'm averaging about 13 lots. Even though I have the capability to trade more than 20, okay? Because there's a process that you go through. When you see those big spurts in my trading, that isn't trading that number of lots at the entry. It's once you get a runner going, that's when you want to load in and back up the truck, not in the beginning. If you do that in the beginning and it goes against you, you lose too much money. So you have to let the trade go through to where you would have profited to the point where if it goes back 8 or 10 pips and you get out, you make a good day's wage. And you have to determine what that good day's wage is. And if it goes back and you make the good day's wage, that's fine, because if it turns around and goes the other way, you can go in and reverse. I did that yesterday. Was it yesterday? I made $1,300. Yeah, I started out, I got out, I made $300. Because it went against me, I got out, I made $300. It went way up, it started to come back down, I went back in, and I made another $1,000 by following up after that. So in 3 trades, 3 positions that I took, I made $1,300. So you have to be careful about that initial risk that you're putting on. But the point of the video is, how long does it take from trading a pretty good size account, trading 3 full lots, to the point where you can trade 20 or more lots? And the answer to that, if you do it the right way, is about 3 months. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.